Welcome back to The Explainer, everyone. Man, I am so glad you're here with me today. If you're a focused learner looking to optimize how you manage your money and information, you are in exactly the right place. Today's Explainer is pulling back the curtain on a seriously effective financial optimization, and we're getting this directly from our source material today, which is Day 19 of FinFlow Media's 100-Day Wealth Challenge. You know, often, the biggest financial wins don't come from complex trading algorithms or taking on massive risks. They actually come from the simplest, most frictionless little adjustments we can make to our daily habits. Specifically, we're unpacking what they call the simple free money hack, the high-yield savings account. We're going to explore exactly how this strategy works, why the traditional banking model is heavily tilted against you, and why leaving your money where it is right now might literally be the most expensive, safe choice you can make. Let's get right into it.
Okay, let's dive into this. Is your standard bank account actually losing you money every single day? I know. It feels deeply counterintuitive to even ask that, right? After all, a bank account is supposed to be the ultimate safe harbor. It's where you stash your cash so it doesn't get lost or tied up. But according to the financial breakdown in our source material, if you've got your extra savings just sitting in a traditional legacy big bank account, the answer is a resounding yes. You are literally losing purchasing power daily. This wealth drain happens because of that invisible tax we all know as inflation. When your cash is parked in a traditional account earning practically zero interest, it's just sitting there, completely stagnant. Meanwhile, the cost of groceries, housing, gas, the whole shebang keeps climbing year over year. So, that safe harbor? It's actually a leaky bucket, slowly letting the real-world value of your hard-earned cash just evaporate.
0.01%. That is the microscopic, almost insulting interest rate traditional banks typically pay you for the privilege of holding onto your money. To put that into perspective, it's essentially zero. But here's the most frustrating part of that equation, and something our source material really zeroes in on. While they hand you mere pennies at the end of the month, those exact same traditional banks turn around and use your deposited cash to generate massive, compounding profits for themselves. They take your deposits, and they immediately lend that cash right back out to someone else for a 7% car loan, an 8% mortgage, or a 20% credit card. The bank pockets that massive spread to buy mahogany desks for their executives and fund huge branch networks, all while your money is doing the heavy lifting. They are making your money work incredibly hard, just not for you.
Now, what's really interesting about this is that it introduces a powerful optimization without adding a single drop of new risk to your financial life. Enter the high-yield savings account, or HYSA for short. An HYSA functions exactly like any regular bank account you're already used to. You can transfer money in, transfer money out, set up direct deposits. It's super easy. And it features the exact same rigorous government-backed safety net. It's FDIC insured, meaning your money is completely safe and federally protected up to $250,000 per deposit or per institution. The incredible difference here, though, is that an HYSA can pay you 10 to 20 times more interest on your deposited money. No way, right? Often these accounts are offered by online-only banks that don't have the massive overhead costs of running thousands of brick-and-mortar branches, which allows them to pass those savings directly back to you in the form of significantly higher yields.
So, think about the direct side-by-side comparison. The logic of making a switch becomes incredibly clear because, well, it's fundamentally a choice between active wealth drain and passive wealth protection. On one hand, you've got your traditional big bank account. Yes, it holds your cash securely in a vault, but it quietly enables that daily erosion from inflation we just talked about. The bank wins, and you slowly lose ground. But on the other hand, you have the high-yield savings account. It provides that exact same secure, FDIC-insured hold on your cash, but it actively stops the drain. Instead of letting the bank run off with the entirety of the profits from lending your money out, the HYSA forces your cash to actually work for you. It effectively splits those lending profits with you, making sure your balance grows month after month.
And this brilliantly illustrates the real-world impact of that comparison. Let's put some actual numbers to this scenario so we can see the massive divergence over time. Imagine a hypothetical $10,000 deposit, just left alone over the course of a single year. If you keep that 10 grand locked away in a traditional big bank, our source notes you might earn a grand total of $1 after 12 full months. A single dollar. You literally can't even buy a pack of gum with your annual return. However, if you place that exact same $10,000 into a high-yield savings account, it could easily earn you hundreds of dollars in that exact same time frame. Same money, same amount of time, vastly different outcomes. And the absolute best part? You are generating those hundreds of dollars completely passively. You don't have to monitor charts or lift a finger once the money is moved.
The true advantage of an HYSA really comes down to three core principles: zero risk, zero trading, zero effort. In a modern financial world that is so obsessed with side hustles, complex investment vehicles, and constantly tweaking your portfolio, finding an opportunity with this level of frictionless return is incredibly rare. You aren't gambling your savings on the volatile stock market or trying to time the next big crypto swing. You aren't losing sleep over daily trades or stressing about economic downturns affecting your principal balance. You're simply utilizing a smarter, more efficient banking tool. By doing this with absolutely zero ongoing effort or mental bandwidth on your part, you effectively beat back the erosive power of inflation and protect the long-term purchasing power of your savings. It's truly the ultimate set-it-and-forget-it financial move for the focused optimizer. So the crucial point is immediate action with your cash reserves, specifically your emergency fund. The source material strongly advocates for moving your emergency fund into an HYSA today, and honestly, the logic here is bulletproof. An emergency fund is money you need for those absolute worst-case scenarios, right? Like a sudden job loss, a major medical bill, or a critical home repair. Because of that, this money needs to remain highly liquid and perfectly safe. You can't just invest it in the stock market because a sudden market downturn could wipe out 30% of your cash right when you need it most. But as we've established, keeping it in a standard checking or savings account is way too costly due to inflation. The HYSA threads the needle perfectly. It gives you the rock-solid safety and immediate liquidity you need while actually paying you the substantial interest you deserve for being a disciplined saver.
Which leaves us with this final, incredibly provocative question to close out our explainer today. Your bank is out there, right this very second, actively profiting off your idle cash. They aren't waiting around to put your money to work for their own bottom line. So when will you start? When will you take that zero-risk, high-reward step to reclaim the passive income that rightly belongs to you? It literally takes only a few minutes to set up, but the compounding benefits last a lifetime. I want you to think about that as you review your own financial setup and account balances this week. Thank you so much for joining me to break down this powerful financial optimization. Stay curious, keep optimizing, and I will see you in our next explainer.